Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Frontline stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Frontline is the world's fourth largest oil tanker shipping company. It is based in Bermuda. Its primary business is transporting crude oil. It was founded in 1985. The freight market is very volatile, which makes this stock more risky. That is why this company pays a 26% dividend to compensate its investors for the risk they're taking. Let's get started with the model. This is a small cap company, 1.3 billion market cap. They're trading at $6.60 a share and they have 198 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So this company has negative free cash flow in 3 of the 4 years. Net income is the profit and loss for the company. It's revenue minus expenses. And they have negative net income in 2017 and 18. But positive in 2019 and the trailing 12 months. Revenue is a sales, and that looks really good. It grows a lot each year, from 650 million to 1.1 billion. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Then the difference is the gross profit. And you can see they had a really nice gross profit in the trailing 12 months, over $400 million, much higher than prior years. Then below that is operating expenses. Then below that is operating income. Operating income is how much money the company makes from its core operational business. The company has a good amount of debt, so they have a pretty high interest payment, $91 million of interest they have to pay on their debt. Then there's other income and expenses. And the bottom line of the income statement is their net income, and that's been growing a lot. It doubled from 2019, and it was negative in 2017 and 2018. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Midstream companies tend to have high capex. So they did have negative free cash flow in the trailing 12 months because it looks like they were investing so much in their business. When a company has a lot of capital expenditures, the idea is to grow their business and generate more cash flows in the future. The company issued $98 million of stock in 2019, and it seems like they're issuing a lot of debt because they did have a big negative free cash flow in 2017, so it looks like they needed some debt to fund their operations. They issued $683 million and paid off $134 million, so they issued about $550 million more of debt that year. In 2018, they issued $100 million more of debt. In 2019, they paid down $50 million of debt. And it looks like in the trailing 12 months, it's pretty much a wash. Let's look at their operating cash flow. If a company cannot generate positive and consistent cash flow from its core business, it does not have much of a business, because you cannot rely on debt and equity financing to run your business in the long term. They seem to be generating a sufficient amount of operating cash flow as time goes on. It's up to almost $400 million. And to calculate operating cash flow, you start with net income. That was $140 million in 2019. And then you have to add back the non-cash items that were passed through onto the income statement. They had $117 million of depreciation. That's a non-cash expense. That brings down your net income, but it doesn't affect cash flow. So we have to add it back to the statement of cash flows. And then there's other smaller non-cash items and then changes in working capital. So the company seems to be moving in the right direction. Let's look at a capital structure. 1.5 billion of equity, $2 billion of debt. And they're 42% equity, 58% debt. And their WACC is 5.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 4.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.3 billion. We divide that by 198 million shares. and we get a calculated stock price of $22. They're trading at $6.60, so they're trading at a 70% discount. It's a really strong buy according to the model. Simply Wall Street is at $20, so they're in the same range as me. They're also saying the stock is undervalued. And this company pays a huge dividend, 26% dividend yield. And to calculate dividend yield, you take the last 4 dividend payments, sum that up, and divide by the stock price. Their payout ratio is over 100%. That's annual dividend over net income. We cannot look at the dividend payment over free cash flow because the company had negative free cash flow due to the high capital expenditures. It is possible they're using debt to finance their dividend payments. The stock price was fairly steady for a few years. It did drop and came back up, but it looks like it's been dropping ever since coronavirus came, so it's at a really low point. It's trading at a major discount relative to its high back in March. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $700 today. If you did not reinvest the dividends, you'd have $800 today. The reason the numbers look so bad is because the company did a reverse stock split a few years back. And the company has a pretty low beta, 0.54, so the stock moves about half the market. The stock has gone down almost 50% in the past 52 weeks, much worse than the S&P 500. The low was $5.28, the high was $13. The stock is trading below its 200-day moving average, but above its 50-day moving average. About 2 million shares are traded each day on this stock, and of the 200 million shares outstanding, about half of them are on float. And 50% of the shares are held by institutions. Almost 7% of the shares on float are shorted. The reason the company has such a low short percentage is because Greenwich Holdings holds 40% of the company's stock. The next shareholder is 5%. Let's look at their financial ratios. The average PE in the market is 11.9. The median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Their PE ratio is 4.9, which is much better than the median and average. 4.9 means investors are paying $4.90 for $1 of earnings. Price to sales is stock price over sales per share, they're at 1.2. Price to book is stock price over book value per share, that's 0.9. So they're also doing really good in this ratio. Interest coverage ratio is EBIT over interest expense. They're at 3.9, so they can cover their interest payments. ROE is net income over equity. They have a really good ROE at 18%. Current ratio is current assets over current liabilities. They're only at 0.5, so they can only cover half their current liabilities with their current assets. And the company will probably need more debt to run their business over the next 12 months because they had negative free cash flow. They have negative $400 million of working capital, and they have over $300 million in dividend payments. The best way to look at ratios to compare them to similar companies, I've done videos of 44 midstream companies. Frontline is right here, and the average for all 44 companies is right here. And Frontline has a PE which is pretty similar to average. Their price to sales and price to book is better than the average. They have a bad current ratio, a really good ROE. They have a similar amount of debt as the average company, but they have a pretty small market cap, under $1 billion. The average is $7.5 billion. But they pay a massive dividend, almost 26%. So to summarize, I do have them trading at a 70% discount because it seems like their revenue is growing so much. So it seems like they may have a really good future and they pay such a good dividend. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.